Two of the most boring companies in Britain are currently beating every single American stock I own, with one of them up over 75%. But at the same time, for the first time in months, one of my investments has dropped into the red. So today I'm opening up my entire trading 2 and 2 portfolio and I'm ranking every single stock I own from my worst performer all the way up to my best. And I'll tell you what's actually been going on in each of these companies, the takeovers, the record profits, and where all of the gains are happening. Then right at the end, I'll show you the total profit this whole portfolio has made me, and honestly, it's the biggest number I've ever been able to show on this channel. So let's get started. Now, just remember, I'm not a financial advisor and nothing in this video is financial advice or a recommendation to buy or sell any investment. I'm just a guy on YouTube sharing my own journey. The value of investments can fall as well as rise. You may get back less than you put in, and past performance is no guide to future returns. So please do your own research and speak to a financial advisor before making any decisions. Now, in my last update, I was in a rare situation where every one of my holdings was in a profit. Well, that streak is over because one of them has slipped back into a loss. So let's start with that one, and we'll go from the bottom and move our way up to the very top of the best performers in my portfolio. And at the end, I'll show you the total profit or loss. So in last place, and now in a red position, the iShares China Large Cap ETF. I'm down 3.6% or about £29 on a £774 holding. This fund holds the 50 biggest Chinese companies, so it's Tencent, Alibaba, the big banks, and at times I've actually been up around 10% on this one. But this year, the Hang Seng Tech Index dropped 19% as the big platform companies are spending fortunes on AI, which is squeezing their profits. The strange part is that mainland China shares actually went up over the same period, so it's been a tale of two Chinas, and unfortunately my ETF holds the half that fell. But this is why I keep the ETF as a small, higher risk part of the portfolio, which I'll continue to hold. Number 12, LondonMetric Property, my smallest and most recent holding at £236, up about 5%. Over the past year, LondonMetric bought up Urban Logistics, which helped push its rental income up 16%, and it's now the UK's largest triple net REIT, which basically means that tenants themselves pay for the repairs, the insurance, the running costs. So less risk, and LondonMetric just collects the rent. And recently, they've also just raised their dividend for the 11th year in a row, and they're now bidding for another property company called Picton as well. So small position, but a good income company, quietly getting bigger. Number 11, QYLP, the Nasdaq 100 Covered Call ETF, £1,761 invested, up 5.7%. Now, although this tracks the Nasdaq, this fund sells options against the Nasdaq 100, which means it trades away most of the price growth, but in exchange for a very high monthly income. So the small share price growth is normal because the point of this ETF is income. So today's video is purely share price growth. But if you want to see exactly how much passive income this portfolio pays me, every dividend, every month, the full breakdown, that is next week's video, so subscribe to make sure you don't miss it. Number 10, Realty Income, one of my largest and longest held positions at £1,922, up 5.9%. They own over 15,000 properties. They're sitting at around 99% occupancy, but like most property stocks, the share price has been held back by interest rates staying higher for longer. So Realty Income pays a dividend every single month, and they recently announced their 135th dividend increase since listing. Okay, now we're into double digits with number 9, Aviva, up just over 11%. Aviva completed its takeover of Direct Line last summer, which made it the UK's largest motor and home insurer. Their latest full-year results showed operating profit up 25%, and they actually hit their 2026 financial targets a year early. Interestingly, the share price has gone a bit sideways this year, after nearly doubling over the last few years, with a lot of that good news already priced in, which is a good reminder that a great company and a rising share price aren't always the same thing at the same time. Number 8 is my stock picks pie, around £330, up 11.8% overall. These are a couple of small picks I wanted to try out. So I've got JP Morgan up over 28%, they just posted one of the strongest quarters in their history, over $16 billion of profit in 3 months, up 13% on last year, with record trading revenue. And their next results are out in just a couple of days, so we'll see if that continues. Pepsi, on the other hand, is down 4.4%. Their sales volumes have been falling for years and shares have badly lagged Coca-Cola, and a famous activist investor called Elliott Management has just bought roughly $4 billion in the company and is pushing for big changes to turn it around. I'm just curious to see if there is long-term value here, but it's a very small position. Then number 7, my £1 a day experiment. £1 every single day invested automatically into the Vanguard FTSE All-World ETF. It's now sitting at £457, up 12.8%, which is £52 profit. But you can watch the whole playlist on it if you want to see more. Then the distributing version of that same fund, VWRL, up 14%. Both these have done well as the USA and UK companies making it up, among others, have grown a lot in the last 5 years amid escalating conflicts and the boom of AI. But we're in the top 5 now with EPR Properties, up 18.5%, which is nearly £300 of profit. EPR own experienced properties like cinemas, ski resorts, water parks, that kind of thing. And this year they bought 6 amusement parks from Six Flags in a deal worth around $315 million, their largest acquisition in years. On top of that, they beat earnings expectations again and raised their guidance for the year to come. So this has been a good performer and it pays great monthly dividends that you'll see in the next video. Number 4 is my single largest holding, the Vanguard S&P 500 at £2,263, up 24%. That's over £440 of profit from one boring index fund. The S&P 500 has been setting record highs this year, driven mostly by an earnings boom. Companies in the index grew profits by over 25% in the first quarter and the fastest pace in years. This is with the AI and semiconductor companies leading that charge. So the biggest holding in my portfolio isn't a clever stock pick, it's just the market, and it's beaten most of my actual picks, but not all. And at number 3, Simon Property Group, up 28%, nearly £500 of profit. Simon owned the biggest shopping malls in America, and remember when everyone said physical malls were finished? Well, their malls are now 96% occupied, and this year they beat expectations, raised their profit guidance, and raised their dividend again. Their longtime CEO sadly passed away in March, and the shares initially dropped over 10% on the news, but under his son now the stock recovered and has pushed on to new heights. Okay, now the top 2, and I'll be honest, I really didn't expect these to do so well. They're not hot tech stocks, they're not American sweethearts, they're actually 2 really boring old British companies, but they're my highest performers by a long shot. By the way, if you're enjoying this video, please be sure to click the like button, it genuinely helps and I'd really appreciate it. So number 2, HSBC, up an incredible 73%, that's £623 of profit. Now, you'll remember that this was up around 60% in my last update, and it's just kept going. In February, they reported a record annual profit beating expectations, driven by their wealth business and their Hong Kong operations. The shares hit all-time highs, and over the past 12 months alone, they're up more than 60%. And now my best performing investment is Lloyds Bank, up over 75%, over £600 of profit on just a British high street bank. That means Lloyds has outperformed the S&P 500, the Nasdaq covered calls, every American property giant, everything. So what's driving it? Well, Lloyds profits jumped by about a third in their latest quarter as higher interest rates keep boosting what banks earn from their lending. They're buying back £1.7 billion of their own shares this year, which pushes the value of the remaining shares up. The shares recently touched their highest level in years, up around 50% in 12 months, and they report half-year results at the end of this month. Now, when I first bought Lloyds and HSBC, the UK had just had a disastrous budget, markets were in panic, and I thought, yeah, now's a good time to buy some banks. And now between them, the 2 boring banks have made over £1,200 in profit, plus some very good ongoing dividends. So, to add up every single position we've just been through, the China ETF in red, the slow and steady income stocks, the index funds, the American property, and the 2 shooting star banks, my trading 2 and 2 portfolio is now worth £16,458.51. So the total return of it all is £3,585.20 of profit, which comes to a total return of 39.2%, which is the highest it's ever been. So I'm really happy with that. But I also want to be real as well, because we've had a very good time in the market in the last few years, and I know firsthand from investing through COVID and then the periods of high interest rates and the tariffs and the oil shocks that the markets aren't always so rosy or smooth sailing. But when the markets are good or when the markets are bad, I'll keep investing and pound cost averaging for the long term. I try to pick companies with good track records of steady growth, and I diversify to a few different industries and index funds. No timing the market, no speculating, just buying good assets over and over and holding on. And weeks like this are when all of that boring consistency suddenly looks very, very clever. But guys, that is it for today's video. I hope you enjoyed. Remember to like and subscribe if you want to see next week's video on how much this portfolio makes me in passive income. Any thoughts, good or bad, let me know in the comments, and I'll see you next Wednesday as always on Casual Cash. Cheers.